$202.90. That's what Medicare Part B costs every single month in 2026. Now add a 10% penalty on top of it. Not for a year, not for 5 years, for the rest of your life. That's what happened to a man who did everything right. He kept working past 65. He kept his health coverage the whole time. He never had a single gap. And when he finally enrolled in Medicare, the government told him he'd be paying extra permanently because the coverage he'd been carrying was COBRA, and COBRA doesn't count. Nobody told him. There was no letter, no warning, no form in the mail explaining that the responsible thing he was doing was quietly costing him money he'd never get back. And here's what makes it worse. That's not the only bill sitting on his kitchen table with a legal off-ramp he never took. Same man, same house, paying full property tax in a state that would have frozen it at 65 if he'd filed. Paying federal tax on his Social Security check against an income threshold that hasn't moved since 1983. Sitting through jury duty at 71 because he never checked one box on the summons. 5 bills. Every one of them reducible, delayable, or skippable after 65. Every one of them still being paid in full, because none of them fixed themselves, and nobody at the county, the IRS, or Medicare has any obligation to tell you they exist. This isn't fraud. Nobody's stealing from you. It's paperwork that's never coming. I'm going to walk you through all 5, bill by bill, and I'll tell you exactly what you have to do to stop paying each one. If you turned 65 in the last few years and you're still paying your bills the same way you did at 50, this is about you, not someone else, not a hypothetical retiree in a brochure. You. Because here's what all 5 of these bills have in common. Not one of them is a scam. Not one of them is illegal. Every single one of them is a rule that's been on the books for years, sitting there, waiting. And every single one of them requires you to raise your hand. The county assessor knows exactly how old you are. Your birth date is on file. They are not going to lower your property tax bill for you. The IRS knows exactly how much Social Security you're collecting. They are not going to send you a letter explaining the deduction that could take you off the tax rolls entirely. Medicare knows the day you turn 65. They are not going to warn you that the coverage you're relying on doesn't count. None of that is malice. It's silence. And silence costs American retirees real money every single year. Now, before I go further, I'm not your lawyer, and I'm not your CPA. What I'm giving you is a map, not a filing. The map is accurate. Where you file, when you file, and what you qualify for goes to a professional who actually works for you. Take that seriously, because on a couple of these, filing late costs you the whole year. 5 bills. We start with the biggest one. The one that's probably the largest check you write all year. And the one where the rules change completely, depending on which state you're sitting in right now. So do me a favor and drop your state in the comments before we go, because bill number 1 is going to hit some of you a lot harder than others. In Texas, the moment you turn 65, your school property tax can be frozen, not reduced. Frozen. Locked at the exact dollar amount you paid the year you hit 65, and it never goes up again, no matter what happens to your home's value. Your neighbor's house doubles in value. Yours doubles in value. Your school tax bill doesn't move a cent, but only if you file with the county. If you don't file, you pay the increase like everybody else, and the county will keep cashing that check every year without comment for as long as you keep writing it. Go north to New Jersey. Stay NJ pays out a credit of up to $6,500 a year. $6,500 in the income cap is $500,000, which is unusually broad. That's not a program for the desperate. That's a program most middle-class retirees in that state qualify for and never claim. Cook County, Illinois, the senior freeze, household income under $75,000 and your assessed value locks in place. New York, starting this tax year, raised its senior exemption to as much as 65% of assessed value, up from a 50% cap. Alaska exempts the first $150,000 of your home's value outright. Run the math on what that actually means. Say your annual property tax bill is $6,000. Normal for a lot of paid-off homes in this country. A freeze at 65 doesn't save you money this year. It saves you every year after. Property values climb 3, 4, 5%. 10 years down the road, the unfrozen version of you is paying $8,000, $9,000 a year. The frozen version is still paying $6,000. That gap to $2,000 to $3,000 annually, compounding for the rest of your life, is the difference between filing one form and not filing it. And I want to be honest with you about something because this channel doesn't overpromise. This is the most fragmented item on the entire list. Every state is different. Some counties within the same state are different. The qualifying age is usually 65, but in some places it's 61, 62, 63. The income caps swing wildly. There is no federal senior property tax break. There is no automatic anything, which is exactly why it goes unclaimed. It's too complicated for anyone to accidentally stumble into it, and nobody's coming to explain it to you. One phone call to your county assessor's office. That's the whole ask. One call and the words, what senior exemptions, freezes, or deferrals am I eligible for? And what's the filing deadline? If you do nothing else after watching this video, do that. And if you find out your county has one you never knew about, come back and tell me in the comments, because I guarantee you're not the only person in that county who didn't know. That's bill number 1. Now let's talk about the one you can't call your county about, because this one's federal, and the number at the center of it hasn't moved in over 40 years. $25,000 if you're single, $32,000 if you're married filing jointly. Cross that line in combined income, and the IRS starts taxing the Social Security check you already paid for your entire working life. That threshold was written in 1983. 1983. It has never been adjusted for inflation, not once in over 40 years. Every other number in the tax code moves. The standard deduction moves. The brackets move. The contribution limits move. This one sits there, frozen, while the value of $1 collapsed around it. When that rule was written, a tiny slice of retirees earned enough to trigger it. Today, a retiree collecting an average benefit with a modest IRA withdrawal on top can cross it without doing anything unusual at all. The threshold didn't come for you. You just aged into it while it stood still. And it gets steeper. Between 25 and 34,000 single, 32 to 44,000 joint, up to 50% of your benefit becomes taxable. Above 34,000 single, 44,000 joint, that jumps to 85%. 85% of your Social Security check treated as ordinary income. There's one more line in this rule, and it catches people who are already in the worst possible year of their lives. If you're married, filing separately, and you lived with your spouse at any point during the year, your threshold is zero. Not 25,000, $0. Up to 85% of your benefit is taxable from the very first dollar. So where's the workaround? It's the senior deduction, $6,000 for anyone 65 and older, in effect from 2025 through 2028. And it does something specific. It lowers your adjusted gross income, which means it can drag you back down under a threshold you were sitting just above. Watch the math. You're single, 68, combined income lands at $36,000. You're above the 85% line. Now apply the deduction. Your AGI drops. Suddenly you're not in that tier anymore. Same income, same benefit, different tax bill, fee for no reason other than you claimed a deduction you were entitled to. It phases out above 75,000 of modified AGI single, 150,000 joint. and it's temporary. It expires after 2028 unless Congress extends it. So this isn't a permanent fix. It's a 4-year window, and 2 of those years are already gone. Tell me in the comments if you knew that $25,000 line hasn't moved since 1983. Because when I explain that to people, the reaction is almost always the same. They assumed a number that important must be getting updated. It isn't. That's the federal layer. But there's a second tax sitting underneath it that only applies to some of you. And if you're in one of 8 specific states, you need to hear this next part. 8 states still tax your Social Security in 2026. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont. If you don't live in one of those 8, you're done. 42 states, and Washington, D.C. don't touch it. The federal layer still applies to you, but your state has already stepped back. And notice what's missing from that list. West Virginia was on it. As of January 1st this year, it isn't. The phase-out finished, and West Virginia now fully exempts Social Security. Kansas, Missouri, Nebraska all dropped theirs recently too. The list keeps shrinking, which means if you looked this up 3 years ago and got a scary answer, that answer might be wrong today. Now, for the 8 that remain, almost none of them tax everybody. Connecticut exempts single filers under $75,000 of adjusted gross income entirely, and joint filers under $100,000. Colorado lets anyone 65 or older deduct all of their federally taxed Social Security, all of it. Utah and Vermont both raised their thresholds in the last 2 years, pulling thousands more retirees out of the tax. A retiree living on $30,000 a year of Social Security in any one of those 8 states most likely owes nothing. Which brings me to the trap, Matrieve. And it isn't the tax, it's the assumption. People in these 8 states hear my state taxes Social Security, and they stop there. They budget for it. They pay it. Some of them relocate over it. They never check whether their own income clears their own state's exemption line. A line that in several of these states moved in their favor while they weren't looking. The tax you're bracing for may already not apply to you, and the tax you paid last year may not have applied either. If you live in one of those 8 states, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, say so in the comments. I want to see how many of you had no idea your state's threshold had changed. All right. 2 bills down that involve the IRS. Now, a fast one, the one that doesn't cost you dollars, it costs you days. And the fix is a single checkbox most people never see. There are people sitting in courthouse jury rooms in this country right now in their late 70s who did not have to be there. Not because they wanted to serve, because nobody told them they didn't have to. Almost every state in the union has an age-based exemption from jury duty. The age varies. In some states, it kicks in at 65. In others, at 70, 72, 75. A couple of states set it as high as 80. Mississippi and South Carolina are among the earliest at 65. A large block of states, Florida, California, Texas, Georgia, Michigan, and many more, sit at 70. I'm deliberately not going to read you a 50-state list on camera because the exact tiers differ between sources, and I'm not going to hand you a number I can't stand behind. Look up your own state. It takes 2 minutes. But the mechanism is the same everywhere, and that's what you need to hear. It is not automatic. The summons arrives in your mailbox. It has your name on it, your address, and a date. The court system knows how old you are, and the summons still comes because the exemption doesn't apply itself. You have to claim it. Usually that means checking a box on the form. Sometimes it means submitting a short written request. Either way, it takes about 90 seconds. Miss it, and you show up. You take the day off. You sit in a room. Maybe several days. And every one of those days was optional. Federal court works a little differently, so there's no automatic age exemption in the federal system at all. But federal courts will generally excuse people 70 and older on request. Again, on request. You ask or you serve. Serve if you want to. That's your call. And it's a good thing to do, but it should be a choice. And for a lot of retirees, it isn't, because they never knew there was a box to check. Read the summons. The whole thing, including the small print on the back that most people skip. All right? That's 4 bills. Property tax, federal tax on your benefit, state tax on your benefit, and jury duty. The 5th one is the most expensive mistake on this entire list. It's permanent, it's federal, and the people who fall into it are the ones who thought they were being responsible. 10%. For every full 12 months you delayed enrolling in Medicare Part B, added to your premium permanently, for as long as you have Part B, which for most people means for the rest of their life. The standard Part B premium in 2026 is $202.90 a month. Run it. Delay 2 years, you're carrying a 20% penalty. That's roughly $40 a month on top of the standard premium. Call it $480 a year, every year, forever. Delay 4 years and you're at 40%. $80 a month, almost $1,000 a year out of your Social Security check for a decision you made once and can never take back. There's no appeal for having not known. There's no grace period. The penalty attaches and it stays. Now, there is a way to delay Part B without any penalty at all. It's called a special enrollment period, and it's completely legitimate. If you're still actively working past 65 and you're covered by your current employer's group health plan, and that employer has 20 or more employees, you can delay Part B, penalty-free. When the job ends, you get an 8-month window to enroll. No penalty, clean. That's real. Millions of people use it correctly every year. Here's where it turns. COBRA does not count. Retiree health coverage does not count. A plan you bought yourself on the individual market does not count. None of them qualify as current employer coverage. And that is the trap, because those are exactly the plans people reach for when they leave a job at 66, 67, 68. You leave work. You don't want a gap in your coverage. You're a responsible person. You've had insurance your whole adult life. The idea of going uncovered is unthinkable. So you take COBRA, 18 months of continuous coverage. You never miss a day. And Medicare fines you for it permanently. That's the man from the beginning of this video. He never had a gap. He paid every premium. He did the responsible thing, and the responsible thing was the wrong thing. Because the rule doesn't ask whether you had coverage. It asks whether you had current employer coverage. COBRA is not current employment. It's the ghost of employment, and Medicare treats it accordingly. Now, let me be very clear about who this beat is for, because I don't want anyone misapplying it. If you're already fully retired and you enrolled in Medicare at 65 like everyone told you to, this doesn't touch you. You're fine. Nothing to do. This is for the people still working past 65, the consultants, the business owners, the ones who kept the job for the insurance, the ones about to leave a job in the next year or two and are already thinking, I'll just take COBRA for a while and sort Medicare out later. Don't. Before you decline Part B, before you accept COBRA, before you assume your retiree plan has you covered, call Medicare or your state health insurance assistance program and ask one question. Does the coverage I'm about to rely on qualify me for a special enrollment period? If the answer is no and you delay anyway, that 10% starts running the day your eligibility window closes, and it never stops. If you are still working past 65 right now, tell me in the comments. I want to know how many of you were told this, because in my experience, almost nobody is. 5 bills, 5 actions. None of them take more than a phone call. Property tax. Call your county assessor's office, not the state, the county. Ask exactly this: what senior exemptions, freezes, or deferrals am I eligible for, and what is the filing deadline? Write the deadline down, because in most places, if you miss it, you don't get the break retroactively. You wait until next year and you eat the difference in between. Federal tax on your Social Security. Check whether the $6,000 senior deduction applies to you, and check where your combined income actually lands against those thresholds. 25,000 single, 32,000 joint, with the steeper tier at 34 and 44. If you're sitting just above one of those lines, that deduction is the single most valuable piece of paperwork in your file this year. And the window closes after 2028. State tax on your Social Security. If you live in Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, go to your state's Department of Revenue website and find your exemption threshold. Compare it to your AGI. That's it. If you're under the line, you owe nothing, and you may have been paying something you never owed. Jury duty. Next time that summons arrives, read the entire form. Find your state's age exemption. Check the box. Medicare Part B. If you are still working past 65 years old, confirm your special enrollment period eligibility before you decline Part B and before you accept COBRA or a retiree plan. 20 or more employees, current employer coverage, anything else, and the penalty is coming. That's the whole list. And every one of them has the same shape. The relief exists. The relief is legal. The relief has been sitting there the whole time, and it only activates when you ask for it. None of these will fix themselves. Nobody is going to fix them for you. $202.90 a month, plus 10% for every year he waited, for the rest of his life. That's the man I opened with. And that penalty was the smallest thing he lost. He'd been paying full property tax in a state that would have frozen it the year he turned 65. He'd been paying federal tax on a benefit he could have shielded with the deduction he qualified for. He sat through jury duty at 71. Nobody stole a thing from him. Every one of those bills was legal, and every one of them had a door. And he walked past all 5 of them because nobody ever told him the doors were there. You don't have that problem anymore. Pick one, just one. Whichever of these 5 actually applies to your life, and do it this week. Call the county, check the deduction, look up your state's line, read the summons, confirm your enrollment window. Not next month. This week, because on at least 2 of these, a missed deadline costs you the entire year, and you don't get it back. And if you know someone still working past 65 who's about to leave a job and take COBRA, send them this video before they do. That one decision is permanent. They deserve to make it with the facts.